very rare thing this Saturday morning. We are doing 2 live streams because I think this second one is critical. The first one, of course, is the daily financial news. We got to keep giving you the daily financial news. But this video is very important because we might be on the cusp of a banking crisis. And I think a lot of folks in the YouTube universe are not doing you service. They are focused on the Great Recession. They are focused on bank bailouts. They are focused on the wrong stuff. So first and foremost, folks, I want to let you know that most of the data I am about to share with you comes from Investopedia. This is all data you can go back and look for. Investopedia has a lot of information on this. I suggest you research this weekend because I think what we are on the cusp of might be very similar to what has been known in the history is the S&L crisis. Folks, this is not the Great Recession. This is not similar to that. This is not variable rate mortgages. This is not any of that. What we are looking at is a banking crisis caused for, or I should say, let me back up, a potential banking crisis caused by the Federal Reserve raising rates, causing bonds to be worth less. Yes, folks, as rates go up, historical bonds are worth less. If those bonds happen to be assets held on balance sheets of banks, that can cause mark to market, and suddenly your balance sheet does not look as good. So I want to highlight a couple of things about the S&L crisis that is very, very different than the Great Recession because I think this is important. First and foremost, folks, this S&L crisis was born out of the 1980s, and many people point to Paul Volcker. Remember, Paul Volcker in the early 80s took the funds rate up to 20% to finally break the back of inflation. Second, the savings and loan crisis was a slow-moving train wreck that ultimately took out 1,000 or one-third of savings and loan institutions. The slow-moving train wreck occurred over 3 independent and distinct recessions. The Great Recession was a one and done, right? As we all know at this point. Again, by 1989, 1,000 S&Ls were out of business or failed. What happened? Well, the S&L crisis was born. The genesis, the beginning, the kindling was born out of a volatile interest rate environment of the early 80s. It was born out of an environment in stagflation, think low growth, high inflation. It eventually cost $160 billion, which taxpayers, that's you and me, bore the brunt of that at $132 billion, and ultimately was blamed for leading to the really painful 1990 recession. So what happened? What happened? Again, you have to go back and look at history. I want to give full credit to Investopedia. Just look up S&L crisis. That's what I did for this. So at the beginning of this crisis, if you don't remember, and probably most of us don't, savings and loan institutions were capped at how much interest rates they could pay on your savings. I'm going to make up some numbers. Savings and loans were capped at paying interest of 3%. Paul Volcker comes in and takes rates to 20%. What happened? You and me don't like 3%. We want to go get 15, 16, 20%. So what do? We take our money out of savings and loans and we move it into money market accounts. This is what happened. Can you understand what is happening at Silicon Valley Bank? People and other banks, Wells Fargo, Citigroup, JP Morgan, all of them, they are paying nothing on savings. But what is happening? More and more people are taking their money out. They're moving it to money markets. They're buying treasuries. And as cash balances come down, that is a problem. Much like the beginnings, the kindling of the S&L crisis. So at some point, Ronald Reagan signs what is the name? I actually wrote it down. One sec. Signed the Garn St. Garmin Depository Institutions Act. No idea what it is. I didn't even know it existed. But that is the act that allowed savings and loans to pay more interest. Guess what happened? This is very much what I think happened at Silicon Valley Bank. They start raising interest rates. But guess what? They have to start chasing yield. Guess what banks did? They chased yield. They got more risky. They went out on the risk curve to get yield. They did commercial banks. They did commercial loans. They did junk bonds. And frankly, they created a moral hazard. The savings and loan had a moral hazard thanks to the Federal Savings and Loan Insurance Corporation, where the leaders at the S&Ls could go out on the risk curve. If something broke, they got bailed out. They certainly lost their job, of course, but they did not suffer losses. The Federal Savings and Loan Insurance Company did that. So guess what happens when you raise interest rates? Your cash balances go up, but then you have to chase yield so you have a positive carry. If you are paying 5% to me, you've got to be earning 7, 8, 10 out on the risk curve. So savings and loans grew. Balances grew 50% because they were paying a higher interest rate. Again, Silicon Valley Bank's balances grew by 80% in 2 years because, again, the Silicon Valley was awash in cash. It is interesting to note that the savings and loan crisis was particularly impactful in Texas, where there was a lot of deals done on land. But again, and 50% of savings and loans failed in Texas. Again, commercial real estate proved to be the big issue as bad assumptions, crazy valuations, and debt structures blew up. So again, what I think we are on the cusp of, again, potentially it could be, a pen could be put in this by Monday, is a crisis very similar to the savings and loans. What do I mean by that? Well, what I mean by that is I think it will be slow moving. Any crisis, it's similar to this S&L crisis, will not be quick. The crisis of the Great Recession was fast. I don't know if you remember, but we were all, or many of us were watching CNBC, and one institution after another failed, and it seemed to be peak to trough done in 4, 6, 8 weeks. If this crisis is like the S&L crisis, it will be over years as cracks grow and form, and we find out whose balance sheet is linked to other balance sheet, whose assets are not worth what they think they are. This will not be fast if it is similar. Also, it is important to note that this may not be resolved with one recession. Again, I ask you to go back and look at Investopedia. The S&L crisis was almost a decade in duration, over 3 different recessions. And again, this was caused by the Fed. There is side effects of raising rates so quickly and by so much. It directly impacts bonds. And especially if you are being conservative and buying treasuries and keeping your capital there, those values can fall, right? You take a 10-year treasury at 2.8% and suddenly it's paying 5 or 4.5 or whatever it was. That value can fall a lot. So at the end of the day, I think the crisis we might be on the cusp of is very similar to the savings and loan. I asked you to do some research. Again, I went to Investopedia. I will be doing more research over the weekend. But yes, it is some very interesting times. It is a time to be inquisitive, not scared. This could be all put to bed by Monday. We will see. It could be the start of something big. We shall see. So again, folks, I ask you to look at the S&L crisis. This is not the Great Recession 2.0. It might be a crisis. I want to be clear. This might be a crisis. It is just not the Great Recession. The setup is entirely different. So we do have something back in history. It happened in the 80s. So go check it out. Do some research. See who made money. Again, where there is great pain, there is great opportunity. And again, one of the things that Olivia and I are doing is we are going out to an event in late April to go get educated. I think there is a crash, real pain coming to commercial real estate, and I want to go buy some. So again, folks, if you happen to be interested, where are they? There's Sunny, there's Happy. We're going to go out for a walk, folks. All right, everybody, take care of yourself. Bye-bye.